through. Stick around till the end because we'll be having an extended question and answer session, getting through hopefully a nice dynamic and engaging conversation together. I'd love to really be responsive to where you're looking, what types of properties you're looking at, your strategies, and really catering to that in the content. So let's jump right in. A little bit about me, for those of you that don't know. I've been investing for about 15 years now, based down here in Tasmania. We were living in, my wife Anna and I were living in Sydney for about 6 years, and when we had kids we moved down here to be closer to the grandparents, which is in Tasmania, Hobart, Tasmania. Currently own properties across the country. My investing journey in about 2011, it really moved to trying to understand the Sydney market. I was quite unfamiliar to me. Looking in the western suburbs, that was a lot of the inspiration for me to develop Ripehouse. It's now morphed into a tool, always remaining very close to Ripehouse, the users, investors, to help what I classify as DIY property investors, people who are really empowering themselves with education, research, understanding, helping each other to step forward with confidence and really do amazing things in property. So I would explain myself as a DIY property investor. Ripehouse has morphed and really remains close to investors and their users. We are always trying to improve and adapt and use technology to empower us and help us and not confuse and hinder us. So that's what it's all about. I will be referring back to Ripehouse throughout this evening, but there's going to be a lot of great content in the Renovate and the growth space for you to take away outside of Ripehouse. Let's get through this quite quickly. I want to get to the meat. I've got some really nice, interesting analysis to do tonight that hasn't really been seen before, but it's going to be super interactive. Please ask questions. Please, I'll stop and engage and talk if it's relevant at the time. I'd love to hear from you. Just to get the conversation started, are you currently owning, renting with or without mortgage? Do you currently own any investment properties? And what are your plans heading into 2017? Are you looking in particular areas? Are you trying to execute a particular strategy? Are you buying in 2017? I'd love to hear from you. Let's get the conversation started. A little bit about me, I suppose. I've generally been a renovate for profit and then hold investor. In more recent years, as my portfolio has matured and gone through, I now focus really on cash flow. If I can make profit on the deal, that's all well and good, but it needs to support itself, and my portfolio needs to support itself. So I've sort of migrated from renovate for profit as very heavy bias through to cash flow more these days. So a few comments coming through. Valerio owned 2 properties. Looking for my third, heading into 2017, I'm assuming. I'll let them come through because there might be a little bit of delay on the transmission as I get going through. What I'm going to show you tonight, it is in reference to a renovate for profit strategy. I'm going to be breaking that into 2 different baskets, but I'm going to be talking through it is cutting edge, and I have to say that with all honesty, what you're going to see is a different way of investing, tools and technology really empowering and helping us. It is right on the cutting edge. We're always adapting and evolving and improving upon Ripehouse, but also the research, the technology and the concepts that we employ. It's just backed by common sense, buyer behaviour, how people move into markets, how they move out of markets, and how you as an investor can potentially take advantage of them. So I just wanted to set some ground rules. There's a couple of really clear distinctions that we need to make in our renovate for profit strategy. Nina's mentioning she's from Tassie. Big shout out, Nina. There's a few more of you who have made comments. I'm trying to get through the content here, but great to see a bit of a snapshot. A few of you rent vesting. So Bruce, Robert, Sam, rent vesting. Sounds like 2 of you are actually in Sydney looking somewhere else. Own home without mortgage, looking at renovate for profit. So yeah, there are some of you on the line looking for renovate for profit, some who are not looking for renovate for profit. Okay, and as I mentioned, over on live support You can engage over on live support with any technical issues, etc. Sky, if you are having sound issues, please let me know if anyone is having sound issues. It does seem to be localized to you, Sky, with the sound issues. But yeah, you can chat on here, and you can also chat over on live support if there are any problems. Okay, I just wanted to set these two ground rules. Sorry for that interruption. The one ground rule here, this is a really large distinction that we need to make here because it's going to put us into two baskets. What we're talking about tonight is a renovate for profit strategy. But if you are looking to hold that property into the longer term, the primary outcome that you're really trying to derive from that strategy for that property is capital growth. This is my first assumption. Okay, so if you're looking at holding the property after you do the renovation, your secondary strategy is renovate for profit up front, and then you're holding that property into market and you're wanting to get outstanding capital growth. So it really does default back to the outstanding capital growth component that is organically making you money on that property whilst you are renovating. When you finish the renovation, you're sitting in a market that has great rental dynamic, great growth upside, and then you obviously have the short-term benefit of the manufactured equity and growth through the renovation. So when you are looking at holding a property, I really encourage Ripehouse users to focus on the growth underpinnings of the suburban area. That's your primary motivation, making sure you're defaulting back to a standard capital growth suburb, and you have a couple of filters that you apply. So you want to see a nice strong price disparity in the market, and then also a number of obviously or accessible properties on the market that are in an unrenovated condition. But your primary, when you're looking at holding that property after the renovation, your primary motive should be on strong and outstanding capital growth into the short and longer term. You obviously need to find markets that support renovation, that do support a renovated product and rents and tenant very well, and that also you can buy on the unrenovated side. So that's in the scale downwards, my priorities when I'm looking to hold the property. If you're looking to renovate to sell for profit, it's a completely different ball game, okay? You're looking at different types of markets. You might be looking at scarce markets, so very tightly held, longer tenured, owner-occupier driven markets, because it's really great when you do a really strong and emotive renovation to sell into an owner-occupier market. You know, you can think if a young family or an owner-occupier is coming into the property, they fall in love with it, they're going to catch up into the whirlwind of emotion and overpay for your amazing renovation. That's what we would love to happen, and that tends to happen in really scarce, tightly held suburbs where people pay for a premium product. Okay, we've got to put margin on that. When you're looking at a renovate for sell for profit, you have to have a large margin. That's the only thing you've got going for that property. That strategy is that margin on the sale. You need to stack the deck in your favour, and to do that, you need to target these really tightly held markets. I'll show you exactly how I break that down, exactly how I find the key suburbs for that strategy in the country today or at any time. And then I'll show you the exact streets and types of properties to target. I'll even show you some examples later on. But you need to understand that there are two separate strategies, outcomes, and target markets. Okay, so the first half of tonight, I'm going to focus on the first, which is looking at capital growth, but using the same mechanisms for those of you that have watched a few webcasts more recently, how we target capital growth areas. I'm going to talk to our capital growth system. It's a defined process and system. I'm going to be going over that old ground, so I apologise for the people who have been on the line the last couple of webcasts. It needs to be re-established because I'm going to show you how that can be adapted for Renovate for Profit. And then I'm going to, bonus material, second half, just before the Q&A, I'm going to focus on the scarcity-driven Renovate for Profit and Sell strategy, okay? Also, potentially, the question too, that's a typo there, I've just repeated the question, but it was meant to actually say, we need to really differentiate, are we doing a cosmetic or a structural renovation? Trying to just really clarify that before we start and trying to work through some individual properties that we might find tonight and look at what might be appropriate. It all comes down to what the market can support, okay? Very special bonus, as mentioned, there will be a, haven't been seen this before, a breakdown of how we employ a flipping strategy, Renovate for Profit and Sell. Really powerful stuff. We've teamed with a very well-respected buyer's agent in the country. to put that strategy together. It's going to be dissected and employed tonight because it is very relevant, so watch out for that. As always, please let me know if you've got any questions you want me to slow down, break anything down. It needs to be crystal clear for us all. What I'm talking about here on this next slide, it relates to that first bucket. Okay, so renovate for profit and hold. Primary motivation, capital growth. So I'm going to go through really quickly our core capital growth system, what Ripehouse is really good at, and then show you how that needs to be modified for renovate for profit. Okay, so it's all about increasing your catchment area. To do that, we need to look across the whole country and find the individual local government areas, LGAs, suburbs, and streets set to deliver outstanding growth. Absolutely lead the country. We want to find those areas and give us, de-risk our investment, really set us on that good set in the first year whilst we're doing the renovation. To do that, we might need to look outside of our comfort zone and move into other areas that we're not familiar with. That's called increasing our catchment area. We then get the local government area right. That's really important. We need to make sure that's heading in the right direction. Finding the suburb that's primed and amplifying growth in that local government area. The individual street that's going to suit our strategy and that's going to hit the market, smack bang, delivering growth from day one. Now we need to find the exact property, unrenovated, in demand, and it's going to support our renovation. Then we can negotiate and buy it potentially at or below market. And then that all wraps up into delivering us potentially great capital growth, organic capital growth, in the time that we're holding that property, doing the renovation before we tenant it. Okay, that's what's going to really set us up. And then once we're doing the renovation, we've manufactured some equity, we might refinance. We have an asset that's in a growth market that's going to really give us some excellent returns forwards. So we manufacture equity in the short term, we hold for the long term for really positive outcomes. That's what it's all about. I really want to focus on this capital growth system first, and then I'll adapt it, as mentioned, into the renovation space. So I just wanted to probably say, this is a bit of a stop. Let's have a bit of a deep breath. We'll gather ourselves here. How much would a system like this be worth to you? Okay, just think about these numbers for a moment, what it usually represents in the market. So 5,000 might be an education course or a seminar. 10,000 might be an individual buyer's agent who helps you for one transaction, and you might not really learn much or understand much more from it. No BA cost, no education cost, no transaction costs. What would it be worth to you to access a system like this that you can implement over and over and over and over again, and you can adapt it? So this time around, you might be employing a renovate for profit strategy. Next time, it's a scarcity-driven flip strategy or subdivision. Equally relevant and applicable. The system can be adapted and the technology can be used in the same way. After that, you might be employing cash flow, capital growth, another renovate for profit. The system can be adapted and the software used in different ways. What would that system be worth to you? These are just numbers to start thinking about how property is done out there in the big wide world and how it can be done differently with technology and how the numbers can look a little bit different to that, okay? This is a no BS webcast. What I mean by that, strap yourself in. I'm going to get through some really heavy stuff, but I'm going to try and break it down. I'm trying to try and relate it back to you as an investor and buyer behaviour, common sense. It's about empowering us. If anything is unclear, pull me back. I'll go over it again. I am a DIY property investor. I try and relate and talk to other investors. Let's do this one piece of the puzzle at a time. Okay. First piece, increase your catchment area. I'm going to skip through this quite quickly. In the terms of renovation, it's about, we might be a little bit limited if we're going to perform even a cosmetic reno in project managing something remotely. I'm going to talk through how we can potentially do that and some strategies we can employ. But what we really want to do, if we're holding for the long term, our primary goal needs to be on increasing our catchment area to find the absolute stellar growth markets for now, for the next 3 years and potentially beyond. To do that, there's not much chance it's going to be around the corner from where you're based, where you're currently experiencing investing in. We might need to spread our wings a little bit further and access that outstanding potential. Okay, not much chance you'll luck box it today. In the next 6 months, it's going to be next door to where you've grown up. Okay, this is the comfort. How far can you spread that out across the country to access these amazing markets and still have confidence in project managing a renovation? That's the question. And it's about helping and supporting, and I can break down some tips that we can employ to make that process a little bit simpler. Okay, it's all about helping each other, improving our comfort level, having the research to back us up, and then the support to be able to make decisions. So just a bit of a tip. I'm going to be showing a Ripehouse page in a moment, but the way that we generally do this is not by looking at state-by-state property clocks. You see this in the media, you see this in other sources of research potentially. People grabbing storylines derived from Queenslanders in the boom time, Sydney, New South Wales, it's in the slowdown phase. That is a generalisation, it doesn't mean anything, and it's not helping us in understanding where we should be investing. It's too general. A state might move in different directions at different times in different places, and what you're looking at might be an aggregate of all those things. This is not the way to increase our catchment area. One way I can demonstrate to do this, but it's obviously using the Ripehouse software to make a point. You can see how we do it in Ripehouse World, and then you can take that away and apply it elsewhere. I might just pause things here, a quick check, everyone following along, seeing, hearing correctly. I'd love to see any feedback. Just making sure that software is working, everybody's here and listening and able to follow. Any feedback will be great. Here we are on ripehouse.com.au. I'm already logged into the page. Those of you familiar with the home page, yep, all good. Thanks, everybody. Those of you familiar with the page, we can now log into our dashboard. This is your daily hub. This is where you navigate throughout the site. It's got everything you need to come back to day after day. Okay, just some really quick tips. We've got the Frontier Investor, daily content from over 30 property experts in the industry, really providing us with some amazing insight. No advertising. It's all about helping and empowering DIY investors. Learning modules, that's where we have our research reports, any FAQs, tutorial videos, a lot of advanced stuff I won't go into there. We really want to focus on these 5 layers of research. So state level, LGA, suburb versus suburb, street versus street and property, and then we've got some advanced stock-like analysis tools there. You can see the news feed here, which is updated whenever we have new content. Lots of different contributors you can see coming through. REI V CEO contributes for us, REI New South Wales President John Cunningham contributes, and lots of other experts in the industry providing really interesting insight for us to help us. You can see advertising for events and all the reporting, etc. is put through your news feed. I'm going to start here. I'm going to click on the state of the states. What that's going to do, it's going to load up our state versus state, our property clock information for states. This is owned wholly by us. We calculate this on a daily basis. We're not referencing back to other people or other research providers, etc. One thing that we really focus on within Ripehouse is owning all of our own data and data sets, because we can do amazing things with that data, and we can do that in a timely and live fashion. So whenever you see a heartbeat within Ripehouse, it means that that data is generated live today and updated. So you can see here, it's a little bit counterintuitive. It's saying that Queensland is in the slowdown phase at a state level. That means that potentially Southeast Queensland and Brisbane is still in the growth and recovery phase, whilst coastal, regional, inland might be definitely in the trough and slowdown phase. So as an aggregate, it doesn't really mean much. But what we can do, we can click on a state, we can click on Queensland as an example, and that is going to take you into the LGA Research Assistant tool. So once again, you can see the heartbeat. This is now showing us every LGA in Queensland. You can then filter these to only show us the LGAs that are within the optimum buying time of the property clock, between 8 and 10 o'clock. So once again, this is not suburb, this is not city versus city property clock information. You can't buy a property in Sydney, you have to buy a property in Sydney. So we have to find an LGA that is in the optimum buying opportunity in the property clock, and then the peak suburbs within that LGA after that. But this is a really handy tool to get us down to a very short list of LGAs very quickly. Another really awesome filtering process within this page is the opinion score. So you can click on opinion. It will then order the LGAs based on how well this local government area is regarded by the industry. So we are monitoring sentiment in media, in research, Real Estate Institute members, all of the stuff that's coming through the Frontier Investor, all media that's associated with property, positive mentions. We are rating that and assessing the expert status of the person who's talking, and the higher the score for that local government area, the more positive sentiment is attached to it, okay? So potentially the word is out there, and obviously a lot of people are talking about the city of Brisbane, but somewhere like the city of Cairns is growing very quickly in terms of lots more positive sentiment attached to that LGA. Other places like Bundaberg, Scenic Rim, Toowoomba have just come on the scene quite recently. Places like the Gold Coast, believe it or not, are actually detracting in terms of the opinion score of that LGA, even though it's still in the buying window. So there's a lot more to this page. I'm really scraping the surface to get through tonight to get to the Reno stuff. But I just wanted to go back and just make that point about the importance of live data. Because you have noticed for the heartbeats, it's critical to your success because timing is everything to get this market right. If we're buying for growth and then renovation within that, we don't want to have too much market heat in that market. We want to buy at the optimum time that we know the market is about to go forward. We don't want to hold a property without any growth. We don't want to buy in a heated market where there's lots of other investors and owner-occupiers falling over themselves because generally there's not many unrenovated properties in that time. We need to get in, beat the heat, buy in the buying window, that red slice there, before prices move, before too many experts are in the market. It's really important. We want to have strong predictive measures of market growth, so imminent growth. We want to be pretty reasonably sure that growth is likely to occur soon, not too soon, not too far away, and develop and accumulate that holding cost. But as soon as that market heat is developing, we're going to be very sensitive to it because the first things that sophisticated investors look for are unrenovated properties, properties on larger blocks, doer-uppers, and then as soon as the lower sophisticated investors come in, you've got a lot of heat in that market, lots of market people falling over themselves to bid. You, as a more sophisticated investor with a renovate for profit or even just a growth strategy, need to be before that. So I'll show you exactly how to use the software to find that those types of opportunities. LGA level research is really powerful. So we're able to find LGAs across the country that are at the optimum buying opportunity for us. Between 8 and 10 o'clock on the property clock, there's a strong recovery in the market. There may even be some growth already, but things are not too heated and not even starting to slow down at the market peak. Okay? The interplay between the local government area into the suburb, into the street, into the property is very important. We adapt and adopt a holistic approach to property investment. It's all based on common sense buyer behaviour. Why are people moving towards these areas? How can we take advantage of those common characteristics of that buying group and really leverage that for our success? Okay, the next job, when we're at this LGA level, we want to find the individual suburbs that are really suited to us and that are going to deliver growth from day one without too much market heat. So say, for example, we clicked on City of Brisbane. Let's click on City of Brisbane right at the top. We know that the local government area has a tremendous amount of focus on it, has a lot of eyeballs, people already looking at it. Experts have been talking very positively about Brisbane. We know that, okay? This tool now shows us, can we find suburbs within the City of Brisbane? The Explore the Nation tool, it's live once again. Can we find suburbs within the City of Brisbane that don't necessarily have the heat attached to the really strong metrics, okay? So the shape of this chart against each suburb really tells a story. We want to find suburbs that have very strong market metric health. That is, the stars are aligning, the data, the predictive measures are showing that growth is imminent. The higher this number, the further it is out to the edge, the higher the score, the more likely that growth is imminent. The higher the opinion score, the more eyeballs, the more experts are out there talking about it, the more heat that is developing. And then, of course, the interest is the heat. That is investors like you and even less sophisticated in the market. So we're trying to get markets that have really high metric scores without the high opinion or interest scores. Investability means that there's lots of properties on the market in the sweet spot streets that are looking to have really good growth. We want to have a good strong investability score. And income's probably not really important to us in our strategy. We're looking to manufacture growth and potentially yield. Income is yield. We're not necessarily, you know, if we're talking about a cash flow strategy like we did last week, income might be one of our key drivers. In this particular example, I'm not really focusing on it, okay? So income is neither here nor there in this example. So we're looking for a very particular shape here. What we can do is we can filter through, like we have done here in the city of Brisbane, at an LGA level and compare suburbs versus suburbs to find those shapes, or we can align ourselves with an explore strategy. So we've got a few to choose from over here on the left. I'm going to go into those in a moment and discuss the different shapes that are related to each of those strategies and which one might be most appropriate to us, okay? So what we're trying to do is we're finding the suburb primed for immediate growth in that LGA once we've found it, or just think of things a little bit differently. If the software's gone across and found 30 LGAs that are all looking outstanding, it's picked one or two of the best suburbs from each and given you 60 suburbs that are the absolute optimum suburbs at once. That is going to be coming back and is going to be one of those undercover boomerang or big green strategies. So that's effectively what it's doing. You can either go into the funnel, find your optimum LGA, and then find the one or two suburbs that are going to deliver you your outcomes, or you can take a wholesale approach, access the nation, increase your catchment area, and follow one of the defined strategies, which I'll show you in a moment. So I might take a breath there, a lot to take in. I do apologise if I get through it. I get very passionate about property. It's all about finding suburbs that have been laying dormant and until the stars align and positioning ourselves just before imminent growth. Imminent growth is caused by larger masses of buyers. We want to position ourselves just before it. I just wanted to make the point as an example of other Ripehouse users who do this consistently. Guy Williams is a Ripehouse investor. First 10 properties he bought using Ripehouse in 10 months. Average annualized capital growth of 25% on each property. Outstanding. 105% cash on cash return. 6.25% average yield. Okay. If you want to find out more details about Guy, we'll click on the Frontier Investor. We can come down to, it's actually one of our most popular articles here. Over on the right-hand side, it's Investor in Focus Part 2, Guy Williams. This is his 4-part series, how he negotiates, how he manages property, lots of really interesting topics around how he manages a large portfolio and purchases remotely. But this article 2 here is the individual properties he purchased. So you can see all of the details. He has a very particular strategy, but he is outstanding at doing it. And this is a really good demonstration of what Ripehouse is capable of doing. He positions himself just before imminent growth time and time again. Trying to get us a little bit of the way towards being able to do that, understanding hockey stick growth. So hockey stick growth, what I mean by that is stars of, you know, a market's been lying dormant, nothing's been happening, the stars align and growth rockets off. It turns into a hockey stick shape, it really does move. And we tend to see a lot of the patterns that drive this growth repeating themselves over and over and over again. We're trying to position ourselves just before that pattern is going to result in the growth. It's based on a little science, but it is really buyer behaviour. It's common sense. Why do people live and move and transition the way that they do? So it starts with increased demand to live in the area. That might be because like new train line, shopping, schools, transport, marina, business park, hospital upgrades, university upgrades, whatever it may be, it's causing increased demand. That's all we care about, increased demand. That demand, people want to live there. Generally, they test the waters by renting first. So people rent first, it pushes rents up in the area, growth hasn't occurred yet, so yields increase together with the rents. That's our first big signal. Then 6 months or so later, you generally see people loving living there, the job's going well, let's buy. So then you've had an increase in the buying pool, sales volumes increase at the same time. That's our second big indicator. Bit of a check and balance. Are days on market steady and decreasing, showing a stock tightening? You know, lack of supply risk. Lots of developers haven't caught on yet. Days on market are decreasing. the stars are aligning, and this is when growth is likely to be very imminent, okay? So this is a little bit of background. There's a lot of, we're actually going to 121 metrics behind the scenes within Ripehouse. There's a lot more science behind it, but this is breaking down in very simple terms how we can look at these predictive measures for growth, okay? Okay, just so you know, a couple of you have had sound issues, just only 2 of you throughout this evening. If you are having sound issues, it might be because you're also looking at videos, or the bandwidth between you and us might be slowed down a little bit. If it's widely reported, it means it's probably from our side. If it's localized to you, just letting you know it's only 1 or 2 of you that have had issues so far. It might be to do with your internet connection. There will be a recording coming out though. Okay, so what I'm going to talk about now, you can remember back on the Explore Your Nation page, excuse me for jumping back and forth, we have these 3 strategies down the side, okay? You can click on these strategies, and what it's going to do, it's going to go across the nation, find the markets, the LGAs that have outstanding metric and imminent growth recommendations. It's going to pick the optimum suburbs from out of those, and the shape has to conform to the strategy. In this case, it's an undercover strategy. So it's picked out suburbs here in New South Wales, Victoria, all across the country. Okay, it's picked out those optimum opportunities. It's really increased our catchment area in a standardized fashion. I just wanted to explain an undercover strategy has excellent metric predictive health, low opinion and sentiment, low interest by other investors. Okay, that's really key to us. We want to position ourselves before the heat and before people have picked over unrenovated properties. We want to put ourselves out on the ledge a little bit. There might be a further away from the growth occurring, 1 or 2 months. We haven't got all of the comfort and the blanket, safety blanket around the media catching on yet and other experts, but we have to get in there first to get the unrenovated properties. The one thing we look for, outstanding metric health. We really have to focus on the metrics, the data, and to position ourselves just before the less sophisticated investors. Because as the interest starts growing, opinion scores and sentiment improve. It starts being talked about in media, in research, real estate institute members, etc., buyers agents, whatever they may be, start talking. And the suburb will move from an undercover into a boomerang. You can see the shape changes. You can track those within the page. Then investors catch on. The uneducated masses catch on. Investor interest emerges and it becomes a big green. There's a lot of heat in those markets, and the growth underpinnings might still be very strong. Growth might still be continuing for 3 years afterwards, but now you're competing against a lot of investors to buy. That generally doesn't work very well when you're employing a renovate for profit and hold strategy, because you want to get in early in the undercover phase and not have much competition for those unrenovated properties. When you start getting a lot of heat in a market, you see the price disparity closing. You see a lot of investors overpaying for unrenovated properties just to get in the market. It happens all the time. As soon as that price disparity starts closing, we'll probably miss our opportunity to come in and execute our strategy. So we want to position ourselves at the undercover phase, is my recommendation. Really focus there before that gap closes, when we've got a large disparity between unrenovated and renovated. I'll show you how we do that in a moment. Position ourselves for that growth and avoid the heat. So what I've done here, this is where I'm going to get right into the nitty-gritty, guys. We've actually found all of the undercover suburbs in the country as of today. You can see the boomerangs and the big greens if you like. What we've done here, you've found a few. I'm going to use, I have jumped into a few of these before we've come on the line, obviously, to make sure we do have unrenovated properties and to make sure that we've got a larger price disparity. But I'm going to focus here on Cooroom in Victoria first. Has excellent market predictive health. Income is okay, nothing special, but it's good enough for what we're trying to do. We're not really heavily dependent on yield with a renovate for profit strategy. We're going to manufacture high yields potentially from our strategy. Investability is good, okay, quite high. We're going to have lots of choices potentially in this market, is the theory. Click on Cooroom in Victoria. It's going to load up our 4th layer, our explore suburbs, and into the street level now, okay? So now we can compare street versus street. We can find individual properties that are on the market at the moment. We can view their sales listing history, their for sale listing history. We can potentially prime and appraise that property and negotiate successfully on it. What you can see here is the suburb boundary. You can also see each red dot is a property currently on the market. The brighter the red, the higher the purchase price. You can click on all of these toggles down the left-hand side and see exactly where key metrics are at a street level. So this is telling us the darker the red, the higher the concentration of public housing is in that street area. 12.5% public housing there, 12% public housing there, and up in this segments with no shading, we've actually got no public housing, 5% in the suburb overall. You can see exactly where renters prefer in the yellow, owner-occupiers in the green. You can see exactly where houses are preferred in the green, units in the yellow. Interesting, a lot of unit demand along the waterfront, high density to support that water frontage. Houses are over the other side of the highway, interestingly enough, and houses up here on the canal system. Where are the higher rents? As you might expect, higher rents up towards the water, but does that translate to higher yields? Yes, it does. Higher yields in the yellow, higher yields where the higher rents are towards the water. So a lot of demand in this area towards the water in this suburb and not inland. That's going to be key, just remember that. I might just say this page is incredibly powerful. I'm not going to even touch the sides of what it's capable of doing on this page. You've got lots of suburb versus suburb metrics. You can see this suburb versus the suburbs around it in terms of yield, occupancy type, lots of really interesting metrics that we can employ to compare this to its neighbours. You can see all current rental listings, all sold listings in the last 3 years as on a map. You can view those there. You can see the listing history for them all. For each property on the market, you can see there's 26 properties on the market. You can actually see this property here was listed 200 days ago, and it's been discounted by 10% in its listing history. Okay, it's come down from 769 down to 690,000. You can see some amazing repository of information on this page. Okay, what we're trying to do here, without getting ahead of ourselves, we have to find the individual streets to target for imminent growth. I'm going to just go back a step and actually just talk through how we do that. You've found, I'm going out of order a little bit here, I do apologise. The reason why we've come to this suburb, it's very strong capital growth upside. In the short to medium term, it's an undercover suburb. It's one of the best in the country for what we've looked in our predictive measures. We have to look for accessible, unrenovated properties in the suburb. I'll show you how we can find those quickly. And we have to look for a strong price disparity in the suburb. Unrenovated to renovated. But once we get to the suburb, we are there now. We're in one suburb as an example, Karoom. We need to find the individual streets. We have to get this right. If we get it wrong, just think about the suburb that you live in. You know the areas to avoid. You know the areas you would never live in and the whys behind it. We have to focus on the streets where everyone is demanding to live in. You can sort of see it's starting to come towards that water area, but it's critical to get this right. A major component of hockey stick growth, outstanding capital growth with Renovate potential, is the street. We have to get that right. It amplifies our results. Let's have a look at how important it is. If you get the street level right, we've found our research has shown it's 5 street level metrics that we track. When you get those combined together, you can expect 21.9% above average growth compared to the suburb overall. So the suburb goes up 4%, you can expect almost 5% growth in the same period if you get the street right. What does that mean for everyone in Sydney? For the next 10 years, you can expect $240,000 in extra capital growth if you get the street right in your chosen suburb. That's obviously an aggregate of Sydney and the average projections of growth going forward. Okay, but it's really trying to make the point, we need to get these 5 things right. Under 15% public housing in the street, lots of the in-demand property type for that suburb, and strong tenant demand. So above average rent, above average yield, and strong tenant demand, okay? When you get those things combined, it's usually only 10 to 15% of each suburb. It results in that outstanding growth. Just to also probably just reiterate how important location is, these charts show you how sensitive value is to its location towards the closest transport hub, school and shopping. So a kilometre away from the closest major train line is very strong. 250 metres away from the closest school is very strong correlation to growth and value. And up to 1,200 metres away from the closest shop. Public housing has a massive effect on value and growth. Expect to pay 25% more than the suburb average if there's 0% public housing in a street, and 18% or more public housing in a street results in 20% less than the suburb average. Massive volatility based on public housing. Just bring all that back, we make it very easy for you to find the key streets in a suburb. You can see that we have pressed on all of those individual toggles. We don't need to monitor those individually. We just click on the Ripehouse sweet spots. We click on a default capital gains suburb street level analysis. It will automatically dial up all of our tolerances, and we click on apply custom area, and it's given us one area, which was where we'll sort of get into before, which is isolated to be amplifying and driving growth for the suburb forward. So it's only the properties on the market in this street area that we want to focus on. We filter properties on the market. If you can remember back to when the suburb first loaded, it told us that 3-bedroom houses are most in demand. We might want to look for a 2-bedroom house and add a 3rd bedroom. So I'm not going to filter things based on bedrooms here. I just want to look at houses that are located in our custom Ripehouse area, the orange area. Apply that filter, and it's going to go from 26 properties down to 3. Okay? Out of those 3, we want to find an unrenovated property. Next job. This one looks very neatly presented. Federation, no work needed. Obviously, very quickly we can assess that. Next one here is under contract. Let's just use it as a point of an example. Under contract's already been removed and sold. Sometimes the agents get a little bit funny with that. Next one here, on the market, price withheld, 844 square metres, 3-bedroom, 1-bathroom, completely in demand, been on the market for 57 days. It has been updated. Unrenovated condition. Does have reasonably nice polished floorboards, very tired looking outside, completely original kitchen, very tired carpets, fireplace, each bedroom's completely drab, completely original bathroom, really nice large block, already plans for improvements. This is something that's really standing out for a cosmetic reno to start with. Maybe a block split, maybe a full knockdown unit development, but the bones are here to make money on a renovation just off the bat from what I'm seeing. You can see how we've got to it. The software potentially jumps at assessing condition. On this type of property, it's pretty subjective. It might get it wrong if it does use sentiment and artificial intelligence to track how people talk about property. When we override it, I would say this property is in poor condition based on the suburb overall. It will learn from that. We can see that it was originally listed for $750,000 in October. They tested the waters, and now it has price withheld. Okay, contact agent for price. So they've removed the price and trying to assess interest. But we know that potentially 750 is around ballpark for this property. We can see area, suburb information. Skew the comparable data one way or the other based on the location of that property. I just want to clarify that we can use a few or some of the information, because one of the key components of this system is obviously negotiating and buying under market. To do that, we need to assess comparable properties. We need to be able to reliably assess condition for properties and find comparables that are in a similar condition to the property. And then we need to be able to look at, has the listing been listed and then retracted because of lack of interest? Have they started with a higher price and then discounted the price? Have they added, withheld the price and then added a fixed listing price and then removed it? Have they flip-flopped between auction and fixed listing? All of these things might show a disconnect between the vendor and the selling agent. There might be lack of communication, mixed messaging between the two, or distress in the listing, okay? All of these things we can use to quantify and negotiate. You can ask questions like, how long has the property been on the market? Has it been discounted? Is there any public housing around, to create or assess the trust of the sales agent? If they are starting to answer correctly based on what you know, or they are trying to show and disclose that there is a bit of knowledge gap for them, you might be able to build a little bit of rapport and potentially get the agent to negotiate with the vendor on your behalf. You don't need to negotiate with the agent if you prime the conversation correctly, you do your due diligence, you have these types of resources. You can potentially position the conversation with the agent for them to negotiate on your behalf. That's what it's all about, because this is how you can sort of tie it all together to negotiate under market. Before I jump back into the software, really quickly, I just wanted to cover off a few things. I know we've got a few questions that are coming through. Sky in particular, I'll grab that and answer that at the end. Keep the questions coming through. I just wanted to get through this really quickly before we go back into the software and then following through to another couple of suburbs. I just wanted to say a big thank you. You can see it here in front of you. You're on the line. I can see how engaged you are. You've been asking a lot of questions and really interesting topics to jump into a Q&A. You're obviously pretty excited about property. I am as well. Pretty excited about charging towards growth and Renovate for profit and delivering some really cool outcomes for 2017. Based on this fact, you're here, you've taken the time out. I do think that Ripehouse is a perfect fit for you, for other investors, DIY investors, to help each other to use technology and empower yourselves for success. You can see how the system has been broken down. You can see the whys behind it, and I'm going to take you through some really interesting techniques to use shortly, how we can get down to Renovate for profit and flip strategies. This is equally applicable to development, subdivision, cash flow, capital growth. The use of software in different ways, we're on hand to support you, but I really do think it's a perfect fit for DIY investors looking to really achieve amazing things heading into 2017. On that note, before I go back to the software, I'd love to make an exclusive thank you offer. Ripehouse is only available via an annual subscription. We do that because we invest incredibly heavily in improving the software, adapting it, and making it relevant to you. We have to invest in the resources to be able to do that on a long-term basis. It's only available via our annual subscription. The recommendations you've seen in the platform are incredibly specific and valuable. We take huge pride in the LGAs, the suburbs, the street, and the properties that you can find in the platform, but they are valuable in themselves. So it's hidden behind an annual subscription. That's the only way that you can access these recommendations because there's scarcity attached to them. The more people that are out there, we protect you as an annual subscriber. It's only available to you. The less eyeballs, the better. That is why we structure things via an annual subscription. It's usually only available via $1,597 subscription price per annum, okay? Because you're on the line, we've all gathered together. I'm all excited, and I think this is a great fit for you. If you're on the line, you've been invited to this session to start with. You're understanding it, and I can see the engagement on the line. It's a perfect fit for DIY investors. I'd love to get you involved. As an extra incentive, let's do it together tonight. I'd love to offer a $400 saving off that price. Bring it down to $1,197 per annum. It's only available until 11 p.m. To lock it in right now, jump across to www.ripehouse.com.au/bonus. I will just say it is a tax deduction. It is, in some cases, able to be used as a cost that is outlaid to facilitate your investing, to depreciate against the income that you derive from your investing. Just check that with your accountant to make sure it is relevant to you and able to be applied, but in many cases that is the case. The cost of that is a tax deduction against your property income. Only available tonight until 10 o'clock via the bonus page there, /bonus. You click on the big Get Started button that will pre-populate the special discount amount there. Enter in your name, phone, email. Click on the subscribe button. Enter in your credit card details securely via Stripe. That's a world-class international payment processing platform. Your details are transacted with them, not us. They store it, we don't. Incredibly secure. Jump across to that bonus page now. Whilst I now get into the second part of this evening, Reno search number 2. Renovate, then sell. Incredibly different. We have to scrap what we've just seen because now we are looking to sell to a scarce, very hot, tightly held owner-occupier market. We want owner-occupiers to fall over themselves, fall in love, and pay a premium for a premium product. When you're renovating to sell, there's an incredible amount of risk on that transaction. Okay, it's harder said than done. You need to have really high margins, and the way to sort of de-risk those margins is to focus on the cream, the upper end of that market. Scarce markets where owner-occupiers will fall in love with the renovation and overpay They might fall over each other. They go, I want to live here and make this my home. Where there's a premium product, the sky is the limit. Blue sky margins. That's what we're looking for. The better job we do, potentially the better price we'll get for that property. That's what we are positioning ourselves in these markets to do. This is advanced Ripehouse usage. Okay. What you've seen so far is the default tools. It's optimized to get the results really quickly. I don't want to confuse and muddy the waters here, because what I'm showing you is another page within Ripehouse. It is advanced usage. We have lots of different tools that you can use. We've got staff to help support you. We've got tutorials, webcast videos, a repository to help you use the tools. But this is an advanced page. I just need to say that. I'll break it down very simply for you in using it. But what we are finding, just remember, we're looking for owner-occupier driven markets, very tightly held, scarce, close to CBD locations, with great blue sky upside, renovate potential. That's what we're trying to do. I'll show you the page that we use to do that. Okay, let's go back really quickly. I'm going to jump back around. am aware of time. We'll jump back into Ripehouse. I'll go back into the dashboard. So this advanced page, I don't generally cover this in webcasts, is the design your own strategy page. Incredibly powerful. We have over 100 or 121 metrics currently, always adding further metrics. You can construct your own strategy based on those metrics. You can add them together and you can find previous growth attached to that strategy, so you can generate the likely success of that strategy. You can see it in front of you, and then you can also see the individual suburbs that currently qualify. It's incredibly powerful. In this case, this is inside my head at the moment. I want to find local government areas that are trending population-wise in an upwards fashion by an aggregate over the last year of 0%. In English, it means I want a local government area where the population is going upwards in the last year. Anything that's gone downwards or been stable, it has to have gone upwards in the last year. We want to have population pressure on the local government area. First rule, I've added that to the list. Second rule, the suburbs' actual stock turnover has to be incredibly low. Okay? Stock turnover has to be below, so this is the numbers here, there's a whole tutorial around this, 0.001%. It means basically, in round terms, when you sort of look at how the numbers are constructed, less than 10% of the suburb will turn over in any 1 year. That is the second prerequisite of our strategy, very low stock turnover. Okay, next rule, I want it to be a scarcity strategy. So scarcity means in our large cities, it has to be close to the population centre. The driver of scarcity is the CBD. Okay, so I want to see an actual distance to CBD is under an absolute value of 15 kilometres. So within 15 kilometres of the CBD of the city that it sits in. Okay. Next one, I want the actual number of owner-occupiers in the suburb to be below 30%. So less than 30% of owner-occupiers in the suburb. It's an owner-occupier driven market. Okay. You can play around with all of these figures. You can change the tolerances and see how that improves our results. I want the vacancy rate to be very low. Under 1.5% vacancy rate in the suburb. 1.5%. Add that rule. Just double checking. We've got 5 rules there. That is my strategy. I've worked this out in the background. I actually worked with Rich Harvey as a buyer's agent, nationally renowned buyer's agent of the year. This is the secret sauce that he uses in many cases to find properties for his clients in Sydney and Melbourne. We worked together. He's used this system. He's understood the rules, and this is the secret sauce for his scarcity-driven strategy. It's really good in this case. I've made a few tweaks for our purposes tonight for Renovate for profit and flip. Very important. We can click on the process button now. Click on process. What it's going to do for the last 15 years, it's going to look at every suburb in the country. It's going to look at every quarter of every suburb and say, were those 5 rules satisfied? If those rules were satisfied for that period, it becomes 1 buy point. It does that for every suburb, for every period. It's found 2,000 previous periods where they were all qualified for every suburb. It then stops, and for each of those buy points, it's measured the next quarter growth. When you find the buy point, you would expect 4.5% growth, outstanding. For the year after that buy point, you'd expect 11.1% growth. It's an outstanding strategy just for capital growth, but it's really well suited to a flipping strategy. It's now, there are 36 suburbs currently qualified for this strategy in the country. Okay? I'm not going to click on those 36, it will show them to us because I'm going to improve upon this. So you can actually do this over and over. I'm going to decrease the scarcity factor down to 8 kilometres. I want to be 8 kilometres from the CBD of our major capitals. Is that going to have a positive or negative correlation to growth in the next year? Let me know what you think, because the answer is going to be shown to us in a minute. This is incredibly powerful because you can test all of the assumptions that are out there in the market. Do vacancy rates, lower vacancy, have a positive or negative correlation to growth? You can experiment. You can see that the buying points have decreased, but the next year's expected growth has increased. Scarcity, in this case for owner-occupier driven markets, has a positive correlation to growth. It might not be the same for tenant-driven markets. It might not be the same when vacancy rates are high or when yields are above 6%, but for this combination, there's a positive correlation between distance to CBD and growth. And now there's only 14 suburbs that qualify. Let's click on that 14. It will load them up in our Explore the Nation page, and you can see them visibly in front of you. So you can remember, we're not looking at our capital growth tenant-driven metrics market. This doesn't really apply. We just want markets that have stock on market to be able to buy and renovate. Okay, I'm going to use number 1 on the list, Ashgrove in Queensland. Let's try and see if we can find some properties in Ashgrove. We'll load up that suburb. Any questions, please sing out, guys. But what we've done here, we have to go in a different direction. We're selling for profit. We're flipping the property. We want to target owner-occupiers to fall in love with it. We want to find tightly held markets. It doesn't conform to our undercover big green boomerangs. This is using the software in a different way. I had to cover this tonight because Renovate for profit, Renovate strategies need to be broken into 2 buckets. Here, we can do all of our street level analysis, etc., same way. I just wanted to make the point, we want to find owner-occupiers to buy the property. We don't click on the capital gains badge here, we click on the flipping badge, the green badge. This will show us the exact streets, and it's the majority of the suburb, which is the reason why we've come here, but there's definitely an enclave of the suburb that we want to avoid through here. Okay, so we come in and we do our filtering again. We want to find a house in this area, in those orange sweet spot flipping areas for us, and we do the filtering back through in the same way. We've got some interesting properties. It just orders by price by default, so we might start here, 590. So this is an undeveloped lot with a house going in. There was one property from memory of, it might be this one. That's definitely not what we're looking for. It's really strong signs when you see these fully brand new properties that the market can support these types of renovations. There was a property, I'm just trying to dig it up. I think it was this one that's just gone under offer. This is the one here. It did go under offer very recently whilst we've been putting the preparation for this together. 94 Acacia Drive. Obviously don't know the property. There's a lot of due diligence to be done after this that we can't cover in this webcast. But this is showing you've seen the upside, the new properties, what this market is capable of, and you can see the bare bones of this property, the knockdown potential, the full gut and renovate potential. You can see it was listed on the July, and you can see how we've got to it. I hope you can. Any questions, please let me know, but you can see how we can find unrenovated properties in these markets. A huge price disparity, 700,000 through to 1 million, unrenovated to renovated. We can see it on each page. Just wanted to make the point before we get back into the Q&A. Ripehouse is a community of DIY investors. We are trying to help and empower you with technology together and do and support to amazing results. It's all about learning, the resource centre, reports, monthly reports that are published that show the suburbs, see how the software is used, supported by private events, webcasts, and learning FAQs. We do and offer live phone, chat and email support, 1300 number on the website, integrated chat support, pop-up and email support. It's designed to empower and not hinder. It has to help us invest for success. Technology is there to assist. These are some other people in the industry, experts, researchers, buyers agents, even other investors who use and love software. It can be very widely applicable, very powerful. I just wanted to reiterate before we get through to Q&A, exclusive thank you offer is only available tonight until 10 o'clock, okay? It involves a $400 saving, bringing the cost down to $1,197. It includes each of our monthly reports for free. They're usually $97, included to you as soon as they're published as part of your annual subscription. So you can use those as your desktop companion to digest the software, pick all of the suburbs that we're seeing and using the software and finding. You can see the reasons why, and you can see the individual streets and properties to target in our monthly reports. Incredibly valuable. This is a very special offer, okay? Tonight only, this is the final offer before 2017 comes to a close. Final webcast where I'm covering the software of 2017. I've only got 10 spaces available for this to occur. So it's only available for the first 10 investors to take up this offer. One-on-one Skype phone coaching with myself to make sure you're understanding how to use the tools and to implement them for success. I'm only opening up these 10 sessions for the remainder of 2017 to support you heading into the new year, and then the door is closed. It doesn't happen. I haven't made an offer like this for over 6 months, and it will not happen again. Opening up 10 sessions in the final part of 2017. Okay, it's over $1,500 in bonus value. And I do also just want to make this point very clear. This is the final time this special offer will be made in this format, okay? This is the absolute last time in 2017 and beyond. This special discount, those of you I have made this $400 discounted offer going back into other webcasts and events. It will not be made any further in any way in these webcasts and packaged moving for the remainder of 2017 and beyond. So this is the absolute last chance. And just to reiterate that, heading into the new year period, opening up the first 10 to take up this offer will access my time one-on-one. Obviously, very limited in this time of year. That can be used on your next property purchase using the platform. If you'd like it to be before Christmas or after, that's fine. That's only available to the first 10 people to take up this offer on the line tonight. Okay, just a little bit more information about how to lock it in. Head over to Ripehouse, www.ripehouse.com.au/bonus. Click on the big red Get Started button. Last time that price is available in this package with all of the extra goodies, $1,197 per annum. As mentioned, it is empowered and protected via Stripe. I'm going to hit the mute button for a few minutes. This is where you can go away, ask all the questions that you can muster. I'll be then coming back and answering them methodically. I'll be on the line as long as it takes. Once I stop the broadcast, I'll be on live chat one-on-one with you. You've got any subjective questions. Sometimes we have a lot of people asking about certain areas, there's certain strategy, there's certain portfolio, very subjective type content. I will answer them as long as it takes one-on-one tonight with you. But if you don't want to stick around for the questions, I really do appreciate you taking the time out tonight. Lots that we've covered. There will be a recording coming out. I really hope it's motivated, it's inspired. Heading into 2017, you've got some takeaways that you can rinse, repeat, and employ. Thank you so much for coming. For those of you sticking around, I'll talk to you in a few moments. Okay, thank you for sticking around. I'm just going to start working through the questions individually, keep them coming through. We've got Sky who's asked first, does the software give the reasons behind the recommendation? So we do have individual FAQ resources. We do have a repository of recorded events and specific education videos. When we do have investors who have particular strategies, we do record individual FAQs and tutorial videos to address that, to justify the reasons behind the recommendations. So lots of different ways that's done. Potentially the best way to do that, to digest it, is the monthly reports, because that breaks down the methodology. It talks about the undercover strategies, a bit of the theory. We support that with ebooks that go into the research, the methodology. We can talk about previous examples, and then you obviously see the output of that, which is the individual undercovers, big greens, boomerangs, the suburbs that currently qualify. You can then see obviously how the software is used to find the individual streets and properties within. Really powerful. It goes away, finds comparable properties, does the appraisal for you in front of your eyes, and then helps with you to understand what to pay for the property and how to negotiate on it. Any questions at any time about how to use the software, we're on hand via live support to assist and to discuss the whys behind it. Hope that clarifies. Skype on hand if you need to further clarification. Okay, Bruce is just asking, so with the Renovate, he's looking at, done a couple of renos before, looking at Renovate for profit to hold next. Would you recommend which are the big cities to go to? I'm assuming let's just start with Brisbane, Sydney, Melbourne. Obviously a lot of heat's been in Sydney. This is just going to be a really general answer. I don't want to get down the weeds because it's quite a broad question to answer. A lot of eyeballs on Brisbane at the moment from less sophisticated investors. So you've got great market metrics up there, a lot of really positive growth stories, features very heavily in our growth recommendations, but you also have a lot of eyeballs and interest. Suburbs like Chermside, as an example, have been really strong Renovate for profit and growth stories for 3 years. Now you have no unrenovated properties through there. You've had developers picking through it for years. You've had renovators coming through and occupiers. Very hard to find unrenovated properties. So it's about finding areas that have great growth underpinnings and lots of unrenovated properties. So we've found a couple there. There were a few sea change or price people that have been priced out of the Sydney market. A lot of emphasis moving into the Central Coast area up to Newcastle. We're seeing a lot of Renovate for profit and even capital growth fundamentals very strong in that Ripple market out to there. 1 to 1.5 hours commute time into Sydney from that Central Coast area in some cases. Lots of good or large price disparities still, and you think those people that are working in Sydney will have a willingness to pay for the Renovated for properties. So it's probably in answer to your question. It's those the suburbs as we sort of Cooroom in Victoria, doesn't have the heat in the market as much in the Victorian area, but then some of the satellites that are providing the real opportunity for what we're trying to achieve here. Just a bit of a caveat on that. Satellites obviously sometimes have a lower price point. When that occurs, it's hard to find the larger price disparity to be able to justify renovation. I hope what you've also seen tonight just sort of is relevant to capital growth, cash flow. The software can be used differently. If that's your strategy, let me know. I can point you in the direction of recent webcasts that we've recorded that focus on that. Yeah, another question here is from Claire is where do we source our data from? Okay, so credible amount of data. I did mention that we own all of our own data sets in terms of we have a search engine like Google that goes across the internet and gathers together for sale, for rent and sold listings. It does that consistently on a daily basis. Whenever it finds new properties on the market, it will recalculate all of the advanced metrics, days on market, sales volumes, yield, vacancy, for the street, suburbs, LGA, up into the state. Consistently it's doing that, okay? So it's making sure the data is live. Things like public housing concentrations are based on ABS data. Some cases that's a few years late from ABS. So we actually have to manually go in, myself and our team, and vet that data and update it manually. In terms of looking at LGA policies, where have there been public housing complexes built or moved away from? The Rocks is a good example in Sydney. We update that manually. Obviously, a few skip through the cracks, but we have got the most accurate public housing data set at a street level in the country. I can put my hand on. I can state that because we've been monitoring and updating every 6 months as a process. So yeah, look, some data sets we monitor, we update. Things like crime, we actually commissioned that research internally 3 years ago, and now we update that. So we have crime information for all LGAs in the country. That goes into our algorithms. Things like ripple effects, some of the more advanced metrics are internal. We develop those algorithms. Property clock information, we develop those algorithms and employ and vet them consistently. So hope that's answered your question in terms of where is the data source from. Multiple sources, but we're constantly vetting and making sure it is accurate and as timely as possible. There's quite a few questions here that are very subjective. So talking about individual properties, one that's just been purchased in Merewether in Newcastle, one that's just been purchased in Sunshine Coast, one that's been looked to purchase in the Geelong area. I'm not going to go into those individually around what you're doing now publicly. I'll jump on with you privately. Keep those coming through on chat. I'll stick around and answer those individual questions now. For those of you who miss out with questions, I've sort of got through the more general in nature. I'll get to the subjective ones once I stop the broadcast. I can move and transition those over to live chat as well tonight. I really just want to take this opportunity. I understand I've gone over time to thank you for you taking the time out, sticking around. I hope you've got something out of it. I'd love to hear any feedback that you did have, positive or negative. We're always trying to improve and empower ourselves and each other. Anything that you can help us with in positive or negative feedback, things that were clear that need to be cleared up, let us know. Once again, thank you and happy investing.